compound on top of that, higher interest rates that have been going up.
What just happened at Carmax has the entire car industry buzzing, and not in a good way. This isn't your everyday corporate update. It's a development so shocking that it could change how we buy cars, finance them, and even how we think about the future of the auto market. If you've ever financed a vehicle or even thought about it, what's coming might hit closer to home than you expect. Carmax has built its reputation on trust and convenience, but a new revelation has challenged everything we thought we knew about this industry giant. What's behind this sudden upheaval? And more importantly, how could it affect your next car purchase? Stay tuned, because what we're about to uncover will make you rethink the entire car buying experience. Brace yourself, this is one story you can't afford to miss. The bombshell that no one saw coming. Carmax has sensationally dropped a financial bombshell that has every single ear up in the whole of the automotive industry. In its latest earnings report, Carmax revealed a shockingly high provision for loan losses at $12.6 million from $89.8 million a year ago. His isn't just a regular adjustment, it's a bold red warning signal of trouble, not only for Carmax, but even for the used car market at large. Industry insiders and financial analysts now scramble to read the announcement's fallout, as for all intents and purposes, the problems of Carmax could lead to dominoes falling across the US economy. Then there's the context that makes the handover alarming. Rising inflation and high interest rates peppering the American landscape, in turn leaving many a financially pinched consumer. Thus, this shot-up provision from Carmax underscores mounting problems arising from auto loan delinquency, most especially within the subprime borrowers segment, with more clients falling behind in their payments, making the cracks in the system more and more impossible to ignore. It's not just about Carmax anymore, but how far-reaching the effect is going to be felt through the automotive and financial sectors. And this isn't just balance sheet numbers, they indicate the fraying relations of an economy. Recent data sources suggest that auto loan delinquencies have increased by 30% year-on-year, signaling a bleak outlook for the industry. Most affected are the subprime borrowers, which have formed a significant part of Carmax's clientele. As delinquencies grow, lenders will begin to cut back on credit, thereby making it more difficult for consumers to acquire financing for vehicles, and will pile on already cooling car sales. Heaps of implications for average consumers. Certainly, if Carmax, the biggest used car wheel, is feeling such a pinch, we know that the industry is really heading towards stormy waters. Auto finance may be costlier and much more difficult to procure, particularly buyers probably not having that clean credit history. In fact, the financial tsunami might create waves as well in the broader economy, sending ripples on consumer confidence, spending patterns, and even few job prospects in the downstream industries connected to automotive sales and production. This shocker isn't just Carmax's, it can concern all of us. But here's the real kicker. This isn't just a Carmax problem. What if this financial shakeup is a symptom of something much bigger, with ripple effects that could hit closer to home than you think? A warning sign for the US economy. Carmax's shocking announcement is more than a business mistake. It is a warning sign for far bigger trouble ahead. Auto loan delinquencies have risen significantly among subprime borrowers, painting an increasingly grim reality for millions of Americans. Compared to last year, there are 30% more borrowers behind on payments, which reflects rising conflict in consumer credit markets. This is not just about Carmax. These numbers reflect a precarious economic environment, one where rising interest rates and inflation have put household budgets under even more pressure. When auto loan delinquencies rise, the effects will eventually pass a bit further than the vehicle industry. That could escalate further to what is known in economics as the credit watch, and even tightening, a phase where lenders reassess their risk tolerance due to increasing defaults, potentially closing some customers' doors to new car financing. Again, it's not just those buying new cars who are affected. Tightening could extend to those looking for personal loans, mortgages, or credit cards. The impact of all this on a consumer spending economy could be to slow down the economy and intensify financial inequalities across the board. One way of putting it is that Carmax might be the place that is the canary in the coal mine for greater economic problems in the future. The most alarming aspect of this situation is that it can lead to snowballing. Lenders feel more risk now as they begin transferring costs to borrowers in increased interest rates and tighter lending standards. With already higher prices for food, housing, and energy, those additional financial sources might push still more individuals into default or bankruptcy. This is a cycle of economic contraction that begins with fewer vehicle sales and might finally affect industries such as manufacturing, logistics, and retail. The current plight of Carmax starkly reminds by what a close-knit family the whole economy considers itself. It might be just a story on a corporate level. Nevertheless, the undercurrents point to a rather fragile system where debt in the hands of consumers, inflation, and interest rates intermingle in a highly unpredictable fashion. The implication shuts all bottom lines, from merely cancers to businesses and investors, but might also be tested by millions of everyday Americans trying to move around in a stricter economy. The numbers that paint a grim picture. The amount of money that Carmax disclosed in its big shocking announcement has really much an unsettling story surrounding it, as it does a significant one. In the most recent earnings report, the company shocked investors with a grand total of $112.6 million in loan loss provisions. It is a huge jump from the $89.8 million set aside just a year ago, to emphasize that a significant increase is in place as far as auto loan delinquency is concerned. Such figures do not just point to accounting or provisioning changes, but put more pressure on households and hold ominous signs for an industry that is suddenly going broke. Specifying the numbers, Carmax's provision holds under it a $52.2 million increase in lifetime loss estimates on existing loans, which reflects worsened circumstances regarding letting some of its customers go by the wayside with payments. Of this, $60.5 million has been set aside for expected lifetime losses on loans originated in the most recent quarter alone. These numbers tend to consolidate the growing risks within an increasingly deferent auto financing environment, as there are ever more borrowers behind, and defaults come to be commonplace. These statistics relate well with the overall trends of the economy. Indulging in serious consideration while examining above stated statistics, the rate of delinquency in auto loans has increased by about 30% on a year-on-year basis, with the impact felt worse by subprime borrowers. More specifically, risky credit profiles have been the negative end users of this horrible statistic. For an organization like Carmax, all losses incurred will also possibly damage relations with lenders as well as consumers. In addition, increasing defaults will impact profitability directly, creating a knock-on effect that would prove to be more complicated in the financial recovery of the firm. These figures are indicative not only of the balance sheet of Carmax. An increase in the provisions for loan losses will indicate an even broader economic malaise that will probably tighten credit markets and raise the cost of borrowing for all consumers. In time, as difficulties accumulate, these changes may be affected into the used car market and into lending practices and consumer behavior, making this a most transformative moment for Carmax and the automotive industry. The repossession crisis. Carmax continuously faces a growing repo crisis which adversely affects the bottom line and unveils deeper cracks in its business model. The effect of delinquency rates in auto loans increasing by 10 percentage points turns out to be a very devastating experience where more and more vehicles need repossession, thus triggering a snowball effect across the board, not financially and operationally. Each repossessed vehicle represents an estimated loss of $3,000 to $5,000, including costs for towing, storage, and reconditioning before resale. It is becoming increasingly difficult for the company to be profitable under the current repo stacking on the lots. There is a very personal side to this crisis too, as borrowers struggle under high-interest loans with inflation-pressured budgets. Defaults among subprime borrowers have shown a notable increase, reflecting the broader economic strain. Personal stories of customers recount the emotional toll of repossession, one that brings most families with cars into logistical difficulties and the stigma of financial failure. These are quickly becoming the normal narratives entering households, creating an all-too-pessimistic portrayal of economic strain for many. It is creating a reputational risk for Carmax, as surges in repossession are also consumer problems. Stories of repossession circulate on various social media and news sites, and the company is badly accused of targeting at-risk borrowers with loans that have high interest rates leading to unsustainable payments. This could lead to increased perceptions of predatory lending, damaging trust between customers and the company. As competition intensifies, this loss of trust may make it harder for Carmax to attract new buyers. The rise in repossession is beginning to have rippling effects that cannot be ignored. Carmax would have to contend with the operational costs of cars under repossession, the financial impact, and rising pressures to reform lending practices, along with the situation being scrutinized closely by competitors and regulators alike, as the crisis in repossession is likely to affect the entire automotive financing landscape and prompt the rethinking of how companies profit their consumer protection policies. To counteract the growing repossession crisis, Carmax is exploring proactive measures aimed at mitigating its impact while rebuilding consumer trust. One approach includes offering tailored repayment plans or temporary financial relief programs for struggling borrowers, helping them avoid repossession while maintaining their vehicles. Additionally, Carmax is piloting advanced analytics to identify early signs of financial distress among its customers, enabling the company to intervene with support options before defaults occur. By focusing on borrower retention and implementing compassionate lending practices, Carmax hopes to not only stabilize its financial losses, but also reshape its image as a consumer-focused brand in the competitive used car market. The double-edged sword of subprime borrowers. Although Carmax's focus on subprime borrowers would become one of the critical growth engines for the company, this line of business may prove to be one of the greatest vulnerabilities it has amassed. Through financing, this has enabled the company to tap a significant portion of the customer market into the corner market of buyers who would usually struggle to buy cars. However, this approach carries really heavy risks. Most of them have a high interest rate, mostly above 25%, making it almost impossible to escape from debt. For some of them, dreaming of owning a car becomes a financial nightmare. The increasing tide of delinquent auto loans illustrates just how risky this practice has gotten. Subprime borrowers, already stressed by inflation and an unaffordable cost of living, are now defaulting on their loans at record levels. Latest data reveals that delinquency rates in auto loans among subprime borrowers have increased by 30% in the past year, leading to a national increase in repossessions being felt regarding Carmax's profitability and reputation. Although this CAGR over the medium term has been healthy by miles, it has also exposed, in the current economic climate, the downside of a super-heavy reliance on borrowers with limited financial resilience. It has been alleged by critics that Carmax's lending approaches are borderline predatory because they seem to supply loans that are very risky to buyers who do not necessarily have a complete picture of how these loans may affect them over a long haul. With increasing regulatory scrutiny, Carmax may have to revise its lending policies to protect borrowers from untenable debt. The challenge here is that while tightening lending criteria would reduce defaults, it would also drive off very large amounts of their customer base. Carmax will have to strike the right balance to weather this storm while still keeping its competitive edge. So, on the one hand, being markedly reliant on subprime borrowers broadens the market reach and increases sales, while exposing it to ever-widening detractors and increased financial risks. The company must now carefully navigate through the complexities, as the auto loan market has started becoming increasingly unstable due to valorizing practices anywhere in the economy. The stakes are too high. The company's actions months ahead would determine its eventual fate. To mitigate these risks and ensure long-term sustainability, Carmax is exploring alternative strategies to diversify its customer base and reduce dependency on subprime borrowers. By introducing more competitive financing options for buyers with higher credit scores, the company aims to attract a broader demographic, balancing its portfolio and minimizing exposure to high-risk loans. Furthermore, Carmax is investing in financial education initiatives for its customers, providing tools and resources to help them better understand loan terms, interest rates, and repayment obligations. These efforts not only aim to foster trust, but also position Carmax as a more responsible lender in an increasingly scrutinized market. If executed effectively, such strategies could enhance Carmax's resilience while maintaining its competitive edge. But what's fueling Carmax's rise and its challenges goes beyond just its customers. Let's pull back the curtain on the strategy that built the brand and see where the cracks are starting to show. Behind the scenes, Carmax's business model. For a long time, Carmax has been celebrated for its radically innovative business model, from traditional to modern automotive retailing. Carmax's no-haggle pricing revolutionized the entire car buying experience in such a way that customers never have to agonize over whether they have to negotiate when they buy cars from Carmax. They view an impressive selection of vehicles available at pre-specified prices, in their minds keeping it transparent and straightforward inside the store. Attraction to this offer emerges from the consumers who show preference for convenience and fairness, and these have accounted much for building Carmax's stature as a great leader in the used car market. Another prong of Carmax's model is very wide inventory. Carmax has a vast source from which it buys its vehicles, from small sedans to big SUVs. This is what every buyer dreams about. It is diverse, plus the reputation for reliability and good quality that Carmax earned through its inspection and certification practices. But managing the huge inventory is not without its challenges. Vehicles tend to sit on lots for long periods of time, a phenomenon called lot rot, which increases depreciation, as well as costs for repairs and reconditioning. Funding provides the fuel for all Carmax's endeavors. Consumers visit their one-stop shop for car purchases when Carmax offers in-house financing. However, convenience comes at a cost, because a higher-than-average interest rate, particularly for subprime borrowers, charges a financial cost to buyers. All of this eventually ends up contributing to the increasing delinquency and repossession rates, leaving people to wonder how sustainable this type of financing is at Carmax. Carmax's business concept is revolutionizing the entire automotive industry by proving the challenges of it day by day. It is not easy being able to balance customer satisfaction and operational efficiency, while the majority is bent low under economic pressure. The company now faces more criticism for its high pricing in cars and lending practices. It should adapt quickly to change to both protect its reputation and its wallet. Whether or not Carmax manages to evolve against these odds will ultimately be instrumental in defining its ability to succeed in the years to come. To address these challenges, Carmax has begun investing in digital transformation and customer-centric innovations to stay ahead of market dynamics. The company is enhancing its online platform to provide virtual test drives, detailed vehicle histories, and AI-powered recommendations tailored to customer preferences. These advancements aim to streamline the car buying process and make it more accessible, especially for tech-savvy and budget-conscious buyers. Additionally, Carmax is exploring partnerships with third-party lenders to offer more competitive financing options, reducing reliance on its in-house lending practices. By embracing technology and diversifying its financial strategies, Carmax hopes to reinforce its leadership in the used car market while meeting evolving consumer expectations. The ripple effect on the car industry. Those financial litigations inevitably involve other broad-based situations within the automotive sector. Probably the largest used car retailer in the United States, Carmax would theoretically act as a barometer in fitness for the industry. Therefore, the increases in delinquency and repossession of car loans involve symptoms of wider pressure, economic or other elements shaping the vehicle market. Industry analysts watch closely the unfolding of those affairs, since their implications often go beyond Carmax shelves. One of the most prominent shocks is the general stiffening of the industry's lending guidelines. No matter how you consider a spike in delinquency rates, especially most noticeable among the subprime borrowers, lenders are becoming even more careful. Such means less chance for buyers with not-so-perfect credit to obtain financing, therefore reducing the pool of prospective customers walking through dealership doors nationwide. It all means thus, falling out sales of cars increases sluggish inventories, thus subjecting further strains on already grief-stricken companies. As the market cools, some dealers may even be forced to sell at much stiffer discounts into the revenues and profits margin of business. Those have an effect now on areas outside car sales, but further include manufacturing, logistics, and even automotive services. Sales will mean less demand for new vehicles built and the eventual possibility of layoffs. Plus the negative tumble effect, this entire sector disappears on an economy reliant on it.
Pressures that consumers are facing on other things that they buy every day.
Repossessed vehicles entering the auction market could contribute to declining wholesale values, posing challenges for businesses reliant on stable pricing. Add to that, an incredible example, the case study of Carmax's current situation. Indeed, in today's world, it is no surprise for the whole automotive industry, from the smallest parts and services to the largest strategic high-level activities within their supply chain, to be very closely related to the economy. Perhaps it's just a matter of time that the said market players will experience such hardships that are not unlike the ones being faced today by Carmax, including high delinquencies, tight credit markets, and low demand. Spreading the ripple effects heightens the need for innovative adaptability in a sector that has witnessed major and fast-paced changes. The way Carmax and other agencies react to such conditions will define the car buying and vehicle financing future for for many years to come. As these ripple effects continue to unfold, collaboration between industry stakeholders becomes increasingly vital to mitigate the broader impact. Automakers, dealerships, and financial institutions may need to work together to create more flexible and inclusive financing solutions, ensuring that potential buyers with less than perfect credit are not entirely excluded from the market. Additionally, implementing advanced predictive analytics and data-driven strategies could help lenders assess risks more accurately, paving the way for fairer loan terms. By fostering innovation and partnerships, the automotive sector can navigate these challenges more effectively, ensuring resilience in an uncertain economic landscape. Carmax's response: fighting back against the odds. Carmax has taken measures to address rising auto loan delinquencies, such as tightening lending standards and adjusting pricing strategies. And one of the key strategic initiatives by Carmax has been tightening the lending standards for high-risk borrowers. By becoming stricter in their credit evaluations, this company looks to minimize the probability of defaults.
It's really that affordability issue, which is one of the reasons why we're so focused on making sure we have a good selection of cars,
as well as lessen the impact of loan losses conversely. As a proactive measure, it reflects the interest of the company to stabilize finances in tough economic situations. A further adjustment is that Carmax introduced its pricing strategies to compete with the hyperthermic used car market. It simultaneously presented a figure of 4.6% in reduction of average selling prices for used vehicles, through which Carmax aimed to penetrate additional clientele as well as solve affordability issues. This adjustment in the pricing regime can also help improve sales, but possibly alleviate the risk that cars will lose value while on the lot, a phenomenon referred to as lot rot. To bolster its finances further, Carmax added more sources for funding. The company completed 2 asset-backed securities transactions in its fiscal second quarter, a non-prime deal made in June and a second prime deal made in July. The company collected increased liquidity and flexibility in managing its auto finance portfolio through added diversification, thus being able to keep financing choices open to the widest possible customer bases. The company, however, admits that the storm is not over with its current economic challenges. The company has seen that consumers have been under some added pressure, particularly with those who financed their vehicles at higher than average prices and interest rates in recent years. In response, it has been testing several new credit scoring models and strategies across different credit tiers to assess risk better and support its customers as they grapple with financial constraints. Carmax continues to refine the strategy adopted.
got in here to change an industry,
which means that it is very resilient and flexible, trying to uphold its promise with customers as well as being financially healthy. In addition to these measures, Carmax has also begun exploring innovative customer engagement strategies to regain consumer trust and loyalty. The company is focusing on enhancing transparency in its financing process, ensuring borrowers have a clear understanding of loan terms and potential risks before committing. Carmax is also expanding its digital presence, leveraging online tools to provide personalized recommendations and easier access to vehicle histories, financing options, and real-time inventory updates. By aligning these efforts with customer-centric practices, Carmax aims to not only navigate the current economic challenges, but also position itself as a reliable partner for buyers in an evolving automotive market. The price of convenience. It has enjoyed a reputation with consumers for years behind its no-haggle fixed-price model, which gives buyers a stress-free experience by ensuring fixed prices and eliminating the hassle of bargaining. With such grace and transparency, it has found a place in the hearts of many customers. Yet under that consumer-friendly veil lies a bitter trade-off: prices above those of competitors for similar vehicles. In other words, convenience comes at a cost most buyers would have a hard time paying for years to come. Critics argue that Carmax's vehicles are often priced higher than similar options available at other dealerships or through private sellers. A sedan, for example, priced at $20,000 at Carmax, can probably be availed through an entity at lower rates, probably quoted around $18,000. Such differences can really add up with financing in play. Disproportionately affected are budget buyers whose finances are strained anyway while trying to get something to drive. Pricing at Carmax gives consumers the feeling that extra money has to be spent based on lengthy inspections and certifications, when actually it only has to be weighed against its value as it states. The situation becomes more complex with financing, as Carmax offers its own loans. While this simplifies the process for customers, it often results in above-average interest rates, especially for subprime borrowers, leading to higher monthly payments and prolonged debt. Thus, what may begin as an easy experience can very quickly change into a financial burden, which may lead customers to question if the ease of the process was worth that price.
Used car prices, like new car prices, are much higher than what they used to be.
A prospective buyer must understand the price of convenience that comes with a purchase from Carmax to be able to make an informed decision. While some might be attracted by the fixed prices and easy processing, exploring other options such as small dealerships, private sellers, or traditional dealerships without further ado might save them thousands of dollars. With all the changes in the used car market, consumers will have to consider how much convenience is worth against the potential cost. To address these concerns, Carmax has begun exploring initiatives to justify its higher prices and improve customer satisfaction. One such approach involves emphasizing the added value of its services, such as offering thorough vehicle inspections, extended warranties, and access to a wide selection of certified pre-owned cars that meet strict quality standards. Additionally, Carmax is piloting customer education programs to help buyers better understand their financing options, empowering them to make smarter choices. By combining transparency with enhanced services, Carmax aims to shift the narrative from being expensive to offering unmatched value in the used car market. However, whether these efforts will resonate with cost-conscious consumers remains to be seen. Convenience always comes at a cost, but what if the price is more than just dollars? Let's zoom out and uncover how this impacts not just buyers, but the entire industry, and possibly you. The big picture. What does this mean for you? The plight of Carmax has, after all, gone beyond merely being a corporate concern. It really reflects all the difficulties that consumers everywhere face and the economy generally. Rising auto loan delinquencies and repossessions highlight a constrained financial landscape where affordability is becoming increasingly elusive. For many car buyers, it means navigating a market where financing options may become more restrictive, high borrowing rates, and stringent lending criteria nearly sabotaging many from securing the loan. It is bigger than Carmax.
Even the older cars still cost more than they did.
It bears into something even more fundamental than the automobile industry. While lenders start to get serious about risk, consumers may pay more for cars or be excluded from the game entirely. This shall have an effect. Sales of cars will cool further. Dealerships will alter their price strategies, and the whole way Americans buy and finance their cars will change. Where once prudent buyers prowled for the best offers and searched out finance options, these now grow more scarce. Getting that right bargain is thus more important than ever for those buyers seeking a vehicle. Carmax's problem is a cautionary tale about the delicate balance between consumer debt and the economy. As households find themselves stretched thin trying to make ends meet, the ripples are sure to touch other industries, in their credit markets and even employment trends. For everyday Americans, it signals the need to unravel the financial landscape and brace for the likely changes in credit and other economic scenarios. Carmax's problems are thus revealing in how the economy is making transitions. Whether you're a car buyer, a business owner, or watching from an outside perspective, the lessons are apparent. Adaptability and informed decision-making are key to navigating this financial uncertainty. So what do you think? This is a minor glitch, or are we seeing more of a fundamental shift in the car business? Let us know in the comments. The challenges faced by Carmax also highlight the growing importance of innovation in navigating financial uncertainty. As the automotive industry shifts, companies must adapt not only to evolving economic conditions, but also to changes in consumer expectations. Digital tools, such as online marketplaces and AI-powered loan assessments, could redefine how buyers approach car ownership and financing. For consumers, understanding and leveraging these tools may become crucial to finding better deals and avoiding financial pitfalls. The question remains: can traditional players like Carmax adapt quickly enough to stay relevant in this rapidly changing landscape, or will new entrants redefine the market entirely? Thanks for tuning in. If you found this video insightful, don't forget to hit the like button to show your support. Got any thoughts on Carmax's shocking revelation? Drop them in the comments below. We'd love to hear from you. And if you're not already part of our community, make sure to subscribe and click the bell icon so you never miss our next deep dive. Speaking of which, check out the next video on your screen for more surprising stories and insights. See you there.